Hello, hello.
Hello. We are going to give a couple of minutes before starting. Hello everyone. I'm Cristina Rodriguez Iza, a member of the ESG committee of CFA Spain, who is organizing this webinar today. I would like to give a welcome to our CFAs that are connecting from Latin America today. And we have Analia and Claudia from Colchester today with us. Analia, who is the head of distribution of Iberia, Israel, and Latin America, and Claudia, who is our star speaker today. She is head of the investment management team, is MD at Colchester, Singapore, chair of the Pre-Sovereign Debt Advisory Committee, and is CFA charter holder. So welcome, Analia and Claudia. For those of you who don't know Colchester Global Investors, I like to highlight that it's a dedicated asset management company in sovereign and Forex with more than 26 billion US dollar AUM, covering both developed and emerging markets. And I think that the focus in ESG is something in their investment process since the beginning that is a philosophical characteristic of them. And it's about their way to analyze ESG on sovereign, what Claudia is going to elaborate today for us. So Claudia, please tell us more
Thank you very much, Christina, and thanks for the invite to the CFA Society in Spain. Good morning, good afternoon, good evening, wherever you're based. Today we're going to be talking about the topic as it's here on the slide, sovereigns as key ESG players. And as already said, we're going to be looking at governance factors and the ASCOR framework. The ASCOR framework stands for Assessing Sovereign Climate-Related Opportunities and Risks. I know it's a bit of a mouthful, but let's have a quick look what we want to cover. I thought let's just start by thinking about why we would want to think about ESG factor integration in sovereign bonds, how one could integrate ESG factors into sovereign credit analysis, the nuances between sovereign engagement versus other asset classes, as we know them mostly in the listed equity space, and then an example on how practically we can look at the governance factors in the case study of Indonesia, and just an overview of ASCOR. So let's get into it. We've got a lot to get through. So historically, as I already mentioned, we've had investors were looking mostly on ESG considerations, were ESG investors. And then much later, fixed income investors started to join only in 2015 after the signing of the Paris Agreement. Why did they do that? Well, the realization set in that ESG factors are an important part of the risk assessment, also for sovereign bonds, despite sovereigns always being considered generally as lower risk. Or it's been also realized, well, they're not actually quite immune to all these risks, such as financial losses or credit spread widening or default risks. Before we see, and then it's always this argument, well, but it's only an issue for emerging market. And actually, that's not true either, because if we take ourselves back to the euro debt crisis, that was very much a lot of the developed countries having been involved in that as well. And lastly, sovereign bonds actually represent one of the biggest asset classes within fixed income as a whole. So what were the drivers? The ESG risk realization, as I already said, within the asset class, but it's actually not been so difficult to some extent to incorporate ESG risks, as parts of it have been already integrated within the credit sovereign analysis. Even so, they weren't labeled ESG. And there are also new variables becoming more available, in particular the E, the FCOM. And why is that? Because many governments have signed up to net zero or to commit to lower carbon economies. And of course, as globally we have seen regulatory changes, just think about SFDR, as well as client demands have changed as well. So how can we integrate ESG in a sovereign credit analysis, and what are the difference or challenges to equities? Well, and how can we overcome those challenges, I guess, is the other issue. When we started to look at this in 2016, when I joined the UN, the PRI Fixed Income Advisory Committee, we set up in 2018 the Sovereign Debt Advisory Committee, which I also chair, and we got together with some other leading sovereign ESG practitioners and developed the practical framework with all the ESG integrations. Well, what are they? The challenges for a start, we don't have a dedicated ESG framework like you know them in the case of companies where you have the GRI or SASB or ISSB. You don't have this sort of distinction between income biases, which we need to look at when we have EM countries or DM countries. And now, of course, the chi. The chi has been the most important factor. Even so, as I said before, we've looked at that for a long time, as well as the S and the E has come more to the foreground over the last few years. But the chi remains to be the most important factor to date for us. And it's very simple, because if you think about it, the chi sets the framework for all the other factors. So it defines the policies for the education sectors, for the healthcare, as well as for environmental policies, for example. And you can translate that very simply over to the companies. Analogy is where you tend to look at the boards, the composition, or the CEOs, where they put the framework into place as well. Staying with the chi then, here is a sample of factors we can look at, which we have put together within the PRI Sovereign Debt Advisory Group. And don't worry, I'm not going to go through all of them. Don't want to put you to sleep at 7 p.m. in Spain. But if you just want to pick out one, if I pick here at the bottom, the World Governance Indicators, which gives us 6 of them. And they go all the way back, some of them to 1960s, 70s. So we have a very long history of those indicators, and they help us in looking where a country is coming from and what the direction of travel is going forward. It looks at aspects such as a country's ability to vote, but also to remove leaders. How easy is it to conduct business? Is there a lot of red tape? So the government effectiveness, but also it defines the business environment. So the rule of law, how easy or, how easy is it or safe is it to get your money back out? And here, if you do have sleeping problems, here's the solution. have a look at this practical guide to the ESG integration in sovereign debt. The link can be found here as well, and we can obviously share that with you afterwards. Some nuances with regards to sovereign engagement, because it's also part to also help us on the governance side. Why is that? Well, let's take a step back and think about how the clear differences are between engagement from the sovereign issuers compared to other asset classes such as equity or fixed income credit. And here I've picked just a few of those common barriers or concerns when it comes to sovereign engagement. One of the most frequently voiced concerns was that sovereign investors can't vote. Hence, by default, we can't engage. Well, that's true that the voting rights lie with the country's citizens, and we can't vote, but it's actually a misconception as well, because we have done engagement as sovereign investors for such a long time, either via round tables with issuers being on the roadshow, but also via research trips as well. We discussed governance issues with them around how they're implementing certain structural reforms, how the fiscal policy is conducted. Is there a fiscal rule in place? Is this obeyed? There are also topics around a country's progress towards international pledges and how they're being tracked. So all of those, we do look at it. And hence we would say if a sovereign engagement should be considered not as a one-way street, instead it should be conducted in a two-way street. And if it's done effectively, it should reduce actually the risks of the funding costs of the country, and it helps investors to understand much more clearly the risks involved in that country. Again, very briefly, here is the engagement publications. If you want to have a look at it, you can also find it on the website there as well. Now, ESG integration in practice. So how do we do it here at Colchester? So we create what's called a financial stability score, and that's a function of, to some extent here on the left-hand side, that light blue pillar, which I won't be focusing on much today, as I'll be focusing much more on the right-hand side, in particular on the governance side, as well is the ESG factors. And you see here right on the top, governance as the strengths of the institutions. Again, as I said, why is that important? Well, because it dictates the social policies. It will look at the range from education levels, demographics, and we always think about it, about the S and the E as well, from the policy making, how that feeds back into the governance side, the fiscal or the balance sheet positions, which risks we haven't taken into account. So if you take the demographics, if you have in the case of Japan, an aging population, that will have knock-on effects on healthcare costs, pension liabilities, and therefore could fall onto the government's balance sheet with higher fiscal deficits and balance sheets, debt levels increasing. So that shows, depending on how the government's policy making is, to rein this in, and that's where governance comes into place. Equally, if we look at the E, I've picked here resource governance. So you can think of a country which is receiving a lot of revenues from its resources. What does it do with it? So it looks at how is that governed? Is it saving it for the rainy day? or is it spending it all because it's politically popular at this point in time? Though, should these resource-driven revenues, be actually maybe be better off if the economy decides to diversify away from just being dependent on revenue, especially if some of those could become stranded assets for the future and might have negative balance sheet implications going forward. So one way is, hopefully you can see from this simple summary, is this analysis can help to actually combine both pillars. The one on the left, the classic sovereign credit analysis, as well as the ESG factors together, build that what we call financial stability score, or effectively it's assessing on a holistic way the quality or the health of a country's balance sheet. So the better the balance sheet itself, in conjunction with the ESG factors, we would give it an uplift to the valuations in that country. The weaker it is, we would give it a downward adjustment to the valuations. And this is one way where we try to capture all the relevant risks which might have not been included in or captured within the sovereign credit analysis. Engagement, you see, is another part which we include, and as I explained, whilst it's different to the equity side, it still gives us valuable insights into the country to clarify policies and their various frameworks, and that might also feed into the valuation adjustments. And so why is governance so important? Just one time to summarize it, we found the better the governance of a country is, the healthier and better educated the workforce tends to be, and the better the environmental standards. And the end product of that is that it tends to produce better economic outcomes, including more stable debt and currency paths as well. And we can see that even statistically shown. What you see on this chart is the statistical correlation between the 6 governance indicators I was talking about earlier from the World Bank, which are equally weighted against the GDP per capita of those various countries. And if you remember what I said, the higher the governance standards, the better the economic outcomes. And if you look up here, for example, Switzerland, you can see it has very high governance indicators, and I should say they are ranging from a very strong governance indicators within the world governance indicators from a +2.5 to the weakest being a -2.5. You can see that's quite strong, but that also correlates to much higher GDP per capita, so it's a higher income country. Or the opposite is true. If you look on the left-hand side, you could pick, for example, Nigeria, where governance indicators are weak, you're going to have lower GDP per capita. And here, I'm not going to go through all of them, but I think the question is, here we're looking at 11 risk factors. I'm going to be focusing on the governance indicators here down there. There are 3 of those. A lot of times the question's being asked, how do you choose which governance factor or which factors in general to use? The way we think about it is that we want to look at the most material factors. And of course, you could pick a lot more indicators, but then you need to ask yourself the question, are they capturing anything additional, or are you already capturing everything you have now, because you don't want to have it biased and tilted? So you can see here again, I've mentioned already a few of those before. the government effectiveness from the World Governance Indicators, regulatory quality, but also the rule of law together with the property rights. They're very important from an investment point of view. And the way you can also think about it is the less, together with a regulatory requirement or government effectiveness, the less red tape you have and the better those property rules are regulated, the more likely a country will attract new business, will attract more FDI inflows, and the more FDI inflows you're going to have, it hopefully be used productive capital, and it should support GDP growth, and therefore should help a country to either go to the next developmental level, or if it's developed country, it is going to remain competitive going forward. So what if we look at a country's balance sheet here in the case of Indonesia? On the left-hand side, here is the balance sheet of Indonesia, just a few economic indicators, gross government debt and net debt, very healthy, below 40%, equally primary balance almost flat, and GDP at a healthy 5.3, excellent position, great, with a positive 1% of GDP. Now on the right-hand side, it looks like I didn't finish the slide. It's half finished, but I thought let's just work through that together. So I'm here picking, especially on the governance, let's look at the tax take. I've basically looked here, and what it shows is that relative to the others, Indonesia, here in blue, actually lags its peers. But there's also on the positive side, there's actually quite a good potential for Indonesia to broaden its tax base. Why is it lower? Well, it's also a function on the governance side. So you can see here again, display the 6 world governance indicators. I said you can go back quite a long time, but you also can do just a time snapshot, compare it to its peer again. Here I've just picked 3 years in which I'm going to compare it to itself. And you can see the blue bar is 2023. The closer those bars are to the 0 line, the weaker the level of governance, the closer they are to the 100 line, the more or the higher the governance indicators are. So if you then look across the board, generally, Indonesia's governance indicators have improved, but there's obviously still a lot more to come. And as these indicators improve over time, you will also see that the tax take is picking up. But, you know, quite certainly quite an improvement from the past, in particular, cutting this red tape, this government effectiveness, we have seen come through, and that actually has helped pick up on FDI inflows as well. So I'm not gonna go through the S and the E. Now let's fill in or put this together on our ESG box. So we have seen the left-hand side, as I said, the balance sheet looks pretty good in the case for Indonesia. And if we look on the ESG factors, we have seen that Indonesia has improved some of its governance standards, which I didn't show you, but you can look it up as well. It benefits from a young population, so less knock-on effect on the fiscal side, actually the opposite, supporting that. But there's always a but. It needs to train its younger population to be competitive relative to its peer, to make it up to its next income ladder. Additionally, we have seen, obviously, as we know, Indonesia faces physical climate risks, particularly via sea levels rising. So that's obviously having a cost implication, but also transition costs that Indonesia is facing to reach net zero commitments by 2060. But it has secured, to mitigate some of that, over $20 billion US dollars from the JETP program, which stands for Just Energy Transition Partnerships. So overall, if we're putting both pillars together, we do give it a small downward adjustment to the financial stability scores, and that will have implication on lowering the valuations as well. So I hope I've managed to give you a little overview on the governance side, how we use it or how we think about it within the sovereign space. And I've also told you, actually, there are no frameworks within the sovereign space as of yet. And that's true. The first one we have been working on since 2021 is the ASCO framework. Again, as said, it stands for Assessing Sovereign Climate-Related Risks and Opportunities, or short, ASCO. And what we have learned from the equity side was that a lot of ESG frameworks had been created and were proliferating or really competing against each other, and gave actually companies a lot of headache on the reporting side. So we precisely wanted to avoid this and got together with a lot of investor networks, such as the PRI, SURA in Latin America, Ceres in the US, ASGCC, and so forth, and 6 of asset managers on the sovereign side, one of which Colchester is, to create this framework. The framework itself is based on freely and publicly available data. It will provide an independent assessment. What do I mean by independent assessment of the countries being done by the academic expert from the London School of Economics or the Transition Pathway Initiative. And it will also help us investors to facilitate on the engagement side. And that's quite important, that independent assessment, because when we go out now and engage with different stakeholders, we're all singing from the same hymn sheet, whereas before the first half of the meeting, we would be just discussing whose data is correct or is the right starting point. And it will also hopefully help investors in setting up net zero aligned sovereign frameworks. What does it actually look like, or how does it work? It consists of 3 pillars. The first one consists of emission pathways. So the first one is the trend, which is more backwards looking. The second 2 are forward looking, and it's based on the principle of the UNFCCC, the common but differentiated responsibilities. Why is it important? Because we don't want to withdraw capital for countries which actually need it the most. And then the pillar 2 is around climate policies. And here again, that's where the governance side comes in quite significantly. You can see that this climate legislation, that requires it, what's the responsibility, who is implementing it, and who's checking it at the end. Carbon pricing is obviously another one, sectoral transition, and so forth as well. And then the last and the third pillar is about climate financing. So that's like developed countries are putting in money for the developed world, and developing countries showing the transparency of how they are using or the climate spending or costing as well. And I think what's quite interesting here, you can see we started out with 25 pilot countries, and at the end of 2024, the project now here in the colored ones covers 70 countries, and it's 70 countries across the high income and low income countries. Why did we choose that? Because we wanted to make sure the framework works for all countries as well. Middle and low income countries, some of them are excluded from some of the indicators. And again, that's a fairness process we wanted to take care of. These 70 countries cover over 70% of the global greenhouse gas emissions. Now they cover 100% of the FTSE government bond index, the Bloomberg Global Treasury Index, as well as the JP Morgan government EMBGI Global Diversified. And 85% of the hard currency, the JPM EBI, as well as 70% of the FTSE Frontier Market Index. So you can see it actually covers quite a broad spectrum and should be helpful for investors to even look at or checking where countries are relative to their climate pledges. What made ASCO help us at the end, as I said, it helps us or investors better in understanding climate risks within the sovereign debt analysis, provides a dialogue between the various stakeholders and for engagement on the issue side. Even it might be useful for regulatory reporting and help facilitate new funding instruments with credible or independent KPIs. You could think of sovereign sustainability linked bonds, which we have seen in the case of Chile and Uruguay, and most recently in Thailand. You can also think of supporting it for risk climate management, which is obviously for countries as country governments set the policies for the entire business community. And as said before, ASCO is one of the frameworks which covers most of the indicators of the 2.0 net zero investment framework. So that was ASCO. Lastly, I hope I managed to share with you why we should incorporate ESG into sovereign debt, what the challenges are, but they can be overcome if it's done systematically with a qualitative approach as well. Engagement, why it's different, it can be done. And lastly, ASCO, the first ESG sort of framework for the sovereign space. And with that, I'll stop here and hand it back to Christina.
Thank you very much, Claudia. It was very interesting. I have an initial question because you have shared with us the case of Indonesia, making the analysis on how ESG provides additional information of the just traditional, let's say, financial approach. But could you share with us an example where this analysis in the governance of a country stopped you from investing or make you limit the allocation in a particular fund, and how well it worked in terms of performance for the funds or the portfolio that you were analyzing?
Yeah, that's a very good question. The one that springs to mind is actually Russia. And I'm going back here all the way back to 2014 or 13, when Russia actually, if you looked at the balance sheet, it looked really strong. You had a fiscal position, positive. You had obviously oil revenues, the fiscal position went up, then oil prices went up. You had debt to GDP relatively low, around 18% growth. And if you set it off, you had basically no debt whatsoever. If you then removed the oil revenues and gas revenues, you were almost at a 10% fiscal deficit of GDP. So that showed there was a vulnerability from the G side because it wasn't very diversified. But the other part, I think, what's quite interesting on the G side, it had initially set up 2 sovereign wealth funds worth 7% of GDP on both. But then when it got politically, you know, a bit challenging, one of these sovereign wealth funds basically got depleted and used to basically buy votes instead of having it saved for the rainy day. So that just shows how the Chi got overwritten. But we also were very concerned for a long time. If you looked at the world governance indicators, the rule of law remained very weak throughout the periods. And that's whilst the balance sheet on the one side was super strong, the governance side was very weak. And that's why within our financial stability score, you would have said it's going to be a positive one. But due to that Chi, it actually dragged it down to our lowest financial stability score and even kept us out of Russia, you know, before the first conflict between Ukraine and Russia back in 2014 already. So that is an example that the Chi did actually help us quite significantly in recognizing that risk, which you wouldn't have seen in the traditional sovereign credit analysis.
Thank you, Claudia. We have another question in the chat from Sophie. Thank you for the presentation. I have 2 questions. First, how do you weight the E, S, and G pillars in sovereign? And second, how do you practically engage with developed markets issuers, particularly G7 issuers?
Yeah, so with the first question on the ESG weighting, we actually normalize. So we have equal weightings and we normalize then these factors, but it's not that, as I said before, there is this quantitative assessment, and it's a quantitative assessment on the sovereign credit analysis. And then at the end, we put them together, but they're equally weighted. And it's not, you know, 1 + 1 gives 2. There's obviously some judgment call included or some qualitative assessment included in that. The second question, how do we engage on developed markets? We do engage in various ways. You can engage, you know, in Europe very easily as well. It obviously depends on your topic, right? You need to pick what's important, what are the issues you're looking for. We also have a green bond fund, so we do want to understand green bond frameworks, and that's where ASCO also comes in quite useful, because that's where we can also assess if that green issuers are aligned with their framework as a whole. So we engage on that front. There's also collaborative engagements nowadays with developed countries. You could think of the UNPRI in the Australian, where we engage with the Australian government collaboratively with quite a few investors on climate-related or climate change and opportunities. And we have done that for the last 2 years, and we're actually thinking of, or within the PRI, to broaden that out to other countries as well.
Thank you, Claudia, for that. This is Analia. I have a question for you, which is quite relevant given what we have seen in the last few months. So amidst all of the political changes, how will this affect ESG?
Yeah, very, very topical. Well, I think we have seen obviously political changes in the various regions, but I think it's also, and we have asked, you know, people have asked, is ESG under attack? And I think it depends how one defines ESG or for what purposes you use it. So I think given we use ESG factors through the risk management lens, we believe that the risk indicators or factors won't change irrespective of political cycles. And as we talked about, various governance factors, they will remain the most important factors that we see as I set the framework for the E and the S. And we look at that, these implications onto the balance sheets. So if we think about, again, what is a tax collection, the better that tax collection is in a country, it can invest better in infrastructure, education, and therefore it should benefit a country's balance sheet. So I think to answer your question in one sentence, it's for us, it won't change for using ESG factors for risk management purposes.
Thank you very much.
Are there any other questions? Well, if not, I have a last one at least. Regarding the information you use, how do you make sure to get accurate and timely information to assess governance? Because at the end, you know, the success of the score and the process is to have, you know, fast enough information, but at the same time accurate. So how do you detect all these sources if you take different from the countries, from other global institutions, and how you incorporate that, if it's just a trend, if it's just one data that is not going to change structurally the country? How do you take this all into account?
Yes, I think if you think back on the indicators, you know, you've seen earlier within the PRI framework as well as within our framework, and how we integrate ESG is more on a holistic basis. And so what I mean by that is we assess a country's balance sheet and take the ESG factors together with the balance sheet into account. And given these, our financial stability factors, we adjust them for valuations. But I think one also needs to keep in mind, if a country implements reforms, those implementation is going to take some time, and we're not going to see the results for some time. And obviously, it's quite a decision-making process. So I think the way we see, almost like you can analyze our financial stability scores as like a slow-moving oil tanker within the financial stability scores and the ESG factors, because it will take some time, as opposed to, you know, the very quick sort of fast-moving data needing to be integrated, such as you can make the analogy to sports racing cars. I don't think you necessarily need those within the ESG space, because you're going to it's going to be much slower moving to change the balance sheet itself. And you would see that change having come from quite some time over the longer term as well.
Okay, thank you, Claudia. I think there is no more questions in the chat, so we can finish it here. Thank you very much for sharing this time with us, and thank you, Analia and Claudia both, and Colchester for the time and to support the ESG committee in CFA Spain.
Thank you for having us.
Thank you very much.
Thank you.
Bye-bye.
Bye.
Thanks,